Crypto Social Analytics. Today we're going to do a little bit of a discussion about some commentary that Real Vision put out recently, a couple days ago, on probability of a recession. If you all don't know, Real Vision, I think they're a pretty good news service. They were started several years back, and I think their premise is to try to bring um, basically less biased news, and less kind of sensationalized stuff away from the mainstream news services, and so more realistic finance news where they're talking directly to fund managers and more extended interviews and not just kind of grabbing headlines. So I think they're a good service. Again, I'm not affiliated with them or anything like that, but they have some great content out there, and a lot of it is free on YouTube. So yeah, and this isn't in any way to knock Real Vision or to knock Alex Gurovich, who's going to be featured here, but just wanted to kind of provide my thoughts on a couple clips in this video. So let's go ahead and get started.
When I put those together, I think this is potentially the largest monetary tightening in all history.
It is.
How are you thinking?
It is very strong. And then, so I was interviewing David Rosenberg a few weeks ago, and I got a lot of good feedback from this. And generally, I'm somewhat aligned with him. I tend to be at least partially aligned with him, not always perfectly, but we tend to think a lot similar. I followed him for years, and he's kind of giving it. He thinks recession, and that was before the negative print on Q1 GDP, and he thought recession was imminent. But he was giving, I think, like a 20% chance of soft landing. And honestly, I see next to zero chance of soft landing.
So I thought this point was pretty interesting. A couple points from this. First of all, if you don't follow David Rosenberg, he has a Twitter account. He has basically like an economic research service that he provides, but he has a Twitter account, puts out a lot of good free information on kind of global economic analysis. So it's a good account to follow. I thought this was pretty interesting coming from Alex Gurovich. So again, he's a CIO at a fund, and from basically past interviews that he's given, which I've seen, I get the impression that the fund is pretty heavy in the tech sector. In the past, he was quite bullish about basically U.S. tech. So, I remember him saying that the future of economic growth is going to be companies located 100 miles from the Pacific West Coast in the United States. So, it's interesting that he's pretty bearish here. He thinks that there's going to be a pretty significant correction in the U.S. economy. And then, I'm sure he has some type of a bit of an inside view to kind of, how things are unfolding within these different companies within the economy. So I thought this was, pretty interesting, because I guess what's interesting to me about this is, 2 years back, he was, I believe, very bullish. I remember listening to some interviews, 2 or 3 years back, and it's interesting that, a lot of these fund managers who are very confident of kind of the continued growth of U.S. tech are now pretty scared and freaked out by the market conditions and kind of the earnings of a lot of these companies. You see Facebook down 60%, Netflix down, 60 to 80%, which is quite a shock to people. And he discusses Facebook later in this interview and talks about, it's pretty interesting because his perspective is like, well, Facebook is still a great stock. I don't really understand why people are selling it. And, I don't know if I necessarily agree with that, but I mean, Facebook definitely still has a business. It's not like the company is on the verge of collapse, but, I think they definitely have taken a hit in terms of like user traction. So yeah, I guess what I kind of thought was interesting about this is that, to me, I wonder, with kind of this large pullback and decline in the U.S. equity market, there's so many fund managers and so many people that were long U.S. tech equities. Like, I would say, that before 2020, the largest trade that everyone was in, that everybody said was the best. I mean, I remember some of the other fund managers that they had on Real Vision. I think it was, I can't remember his name, not Kyle Bass, but there was another one, another San Francisco hedge fund manager, and they were, all talking about how you should only have the winners, and there's no point in investing in any companies besides U.S. tech companies because they've had the best returns, and that was what a lot of these fund managers were talking about. And it's interesting because now that a lot of those names are just getting smashed the most. Um, it's interesting how many of these funds are going to be hit pretty bad. And I think the other thing that's interesting is, what happens if it does take 10 years to recover, and you have all these like venture capital funds and stuff that are expecting to realize profits within a certain amount of time. It's definitely going to be pretty rough on a lot of those companies. I mean, as I feel like valuations could stay suppressed for a while if the Fed really just continues to unwind this liquidity and then kind of balancing, trying to keep inflation at a reasonable rate while it pays down the debt of the economy. So, yeah, I guess I thought this was pretty interesting, because relative to the 2000 dot-com bubble, I feel like there was just much less money in tech companies than there is now. I think it's like if you look at the U.S. economy, it feels like it's almost like 90% of the capital is in tech companies, and with a lot of those having achieved really crazy valuations because based on the discount cash flow valuations, with interest rates being so low and money being so freely available, a lot of the valuations were just really crazy. But yeah, I just feel like back in 2000, a lot of money was still in traditional companies like GE and I don't even know the other, I don't know, Ford, I guess automotive, different, IBM. I guess a lot of money was still in those traditional companies. So it'll be interesting with all this capital that's kind of locked into these tech companies that are facing some pretty huge gains as the discount cash flows unwinds and then consumer demand falls. It will be interesting to see how these funds react because, yeah, definitely some people are going to be down a lot of money. So, yeah, that's, I could play some of those other parts of this interview, but I think we're going to wrap it up here. Just wanted to kind of provide that general commentary on how fund managers that are really heavy in the tech space are kind of thinking about the current market conditions. So, yeah, I think we'll end it here. Thanks everyone for listening and hope you have a great day.